Welcome back to the Path to Wealth. I'm your host, Hennche, ready to embark on an accelerating journey with you today. Joining us is none other than a true force of nature, a serial entrepreneur, investor, and master of content creation. He's the brilliant mind behind successful Sweaty startup and has co-founded numerous other ventures. We have the one and only Nick Huber, a visionary entrepreneur and a treasure trove of wisdom, gracing our show today. It's an absolute honor to have you on the show, Nick. And let's see what punchy lines we're getting from you today.
Honest, thanks for having me. I'm a fan of what you do. Happy to be here.
Yeah, thank you. Likewise. I think in an ocean of different assets, you're focusing on one that wasn't even there quite long. Like self-storage is something that's kind of a ballooning industry where people are drowning in stuff, and you're totally taking advantage of that human habit. So why self-storage?
It was just a natural, I don't know. I think a lot of entrepreneurs and business owners and even real estate investors can think of a lot of fancy reasons why they end up in an asset class, but it was just a natural step for me. I started a moving and storage company. And since storage was in the name of my moving company, we figured we could use that to leverage a bank loan when we were 25 years old and didn't know what the heck we were doing. And it worked. We got a loan to build a self-storage facility from the ground up. In 2015 is when we started, raising the money and planning, and we opened it for business in 2017. And the rest is history. I like the asset class, and I obviously I'm financially incentivized for the asset class to do well now at this point, but no specific reason why I picked it over multifamily or any other asset class.
Yeah. So what gave you the guts to do that? Like walk out, get a loan, and build something literally from scratch and put it on the market?
Mm-hmm. Yeah. My father worked for a real estate developer, and my father was also a super excitable, charismatic person. He's louder and more energetic than I am, if you can believe that. And we got excited one evening. We were talking about storage, and he said, "Nick, you can do that. Why would you not just go ahead and do it?" And the next day, my business partner and I started looking for property. We found one to buy. Then we went from dinner table to dinner table to dinner table to try to raise the money to do the deal. And I guess when you're 25 and you don't have a wife, kids, mortgage, car payment, it's easier to take risks. And I was an entrepreneur before real estate, which I'm a huge fan of that path of going from small business to real estate, because I think that real estate is a small business. Like, people think of it as passive, but it's not really. It's about hiring and managing and getting things done. But yeah, we built that first building, and it was a life-changing event for me. I mean, we built it from the ground up, and 51,000 rentable square feet of storage, all-in basis of $2.9 million. That was in 2017. The door opened. We refinanced it in 2019 at $5.2 million. Pulled out a couple $1 million of cash.
Nice.
Refinanced it again in 2021 at an $11 million valuation. Pulled out another big chunk of cash, and we bought out our partners. Now we own 100% of it, and it's been a life-changing deal. And frankly, a lot of the fuel that's allowed us to invest and buy more storage.
I mean, this is just one deal. We're just talking about one deal that completely transformed your life. And I love that your dad was just like, yeah, go for it. Why not, man? Go for it. You can do it. Like, where does that come from in him? Like, what encouraged him to... This could also be like the biggest mistake you could have done in your life, like mid-20s, tanked all that LP's money, tanked the bank money.
Yep. We didn't know how to syndicate deals. I didn't get any advice from syndicators, so the structure was very unique in that the bank debt was my equity, meaning we raised 20% of the money for the deal, and the investors got 20% ownership. Even so, the bank loan was personally guaranteed by me, and I had to pay all the bank debt. But basically, it gave me an 80% promote on this deal on the very first one, even though I had absolutely no idea what I was doing, and we don't raise money that way anymore. But my dad also was our first investor, and I didn't realize it, but he didn't really have the cash at the time to be an LP in a real estate deal. He took out a mortgage on our house, our home that we grew up in. He took a mortgage out on it to make the investment with me, $125,000. And if I would have known that he took that mortgage out, he didn't tell me at the time, it would have made my life a lot more stressful. But he got bought out in 2021 at 650 grand of valuation. So ended up being a really, really good deal for him too.
I mean, this is insane because, see, I see the extremes of that. I've done something a little similar, which didn't work when I was pretty much the same age. And I'm on the other end of the spectrum in that particular first deal I made. So for me, it's really interesting to see you had the fortune, maybe the different circumstances. I don't know, maybe you had the week to pull it off. But it's like it completely changed the trajectory of not only yourself, but also your dad's finances. And I think that's the powerful thing that people should take away from entrepreneurship. It takes a lot of guts. Obviously, if you logically think about everything you just put on the table, like it's scary as heck, but it has an exponential outcome to change your life. It's not just incremental, it completely changed the trajectory of your family.
Yeah, it's looking back on it, it's pretty crazy. I don't know that I would recommend a 25-year-old go personally guarantee a $1.5 million bank debt and, raise LP capital from your parents who can barely afford it. And yeah, I mean, that's just dumb luck, honestly. Dumb luck. I mean, we knew what we were doing when we got that thing open and started operating it and renting storage units, but the structure, the finances, our projections were way off. Let's just put it that way.
Yeah. That's good. It worked out, and it fueled something different altogether. And I think that's the interesting thing, that you're a business owner. It's like a passion to you. You love operating.
I think a lot of people, when they're interested in real estate, they think that most real estate empires are built by starting in real estate, just getting started with no money in real estate. And you see it all over social media, get started with no money down in real estate. If you actually study the real estate empires, the families in New York City, Chicago, Los Angeles, the families that own hundreds of millions of dollars worth of real estate, it almost always started through entrepreneurship. Almost always. Francis Greenberger in New York City, we've all read his book, Risk Games. His family was in the publishing and book printing business, a big business, and Francis leveraged that into real estate. A lot of my friends, family entrepreneurship, family business, and when I say business, companies that have, grown to 200 employees and created serious wealth each year, that's how major empires are born. But a lot of people get on social media, they're hanging out on Twitter, Facebook, Instagram, listening to my podcast, your podcast, whatever. They think that I have a W-2 job and I'm going to go straight from a W-2 job to become a real estate investor. And yes, you can. There's people who have done it. My friend has done it, Chris Powers, who you might know of. He runs the Fort podcast. His story is amazing. But for the most part, it takes a lot of cash to get in the real estate game. It takes a lot of cash. So the best way to make a lot of cash is not a W-2 job where you're going to get paid every week. It's entrepreneurship where leverage can kick in and you can make real money. So I'm a huge proponent of starting a company first, worrying about making that money first, and then moving over to real estate. And also the second half of that is just the transition that comes from the skill set. The skill set when you're managing and hiring and running a business and delegating, all those skills are directly applicable to managing and putting together real estate deals. There's people involved. You're going to need to make hires. You're delegating to keep the properties clean and maintained, and you're selling customers. So yeah, it's a win. It's kind of a flywheel. Entrepreneurship into real estate is a flywheel, and I'm lucky enough to have benefited from that.
Yeah. So what are some of the key things that you focus on in terms of keeping the flywheel going? What would you say are the pieces that are crucial to get right? You mentioned hiring. Now obviously you have different structures. you don't take on maybe everything on a personal guarantee anymore. What are some of the crucial pieces that are really important to Nick Huber's success right now?
I think that a real estate career is a journey. At the beginning, you just heard kind of like when I was risk on. I was taking risk and acting what would be an irresponsible way to act now, as I act now. 70% loan on a brand new development and going over budget on a first development. That's a that's not for the faint of heart. But
Yeah.
now that I have something to lose, and we're kind of in wealth preservation mode, and okay, we bought $100 million worth of storage, we're managing it, we're in a different mindset of, hey, how can we use real estate to multiply our wealth snowballs, in a tax efficient way as we kind of look towards the future? It's not, oh, hey, how can we make a couple $1 million quick here? It's, let's buy property, let's manage it well, and let's hold it for a long time, and let's use less leverage. I mean, that's a huge part of it, is that in 2021, about halfway through, we realized, oh boy, this is going really well. We're making these properties a lot more valuable. We have a ton of LP interest. We can talk about how social media has been a part of that. But it was, let's get less bank debt, because all right, we got this net worth, we got this first building, we got 6 more buildings on top of that we bought in 2018 and 19 that are all, solely owned by me and my partner, and they're doing really well, and we're cash out refinancing millions of dollars. Let's figure out what could bring all of this crashing down, and it's too much leverage and it's debt maturities. And so by halfway through 2021, we went from 65% leverage down to 60% leverage, down to 50% leverage. And the deals we're buying this year are no leverage at all. We're buying all cash, just because bank debt is unreasonable at this moment. So yeah, I think the flywheel has shifted. At the beginning, it was risk on, let's get that money. Then it was kind of, all right, let's build the teams, let's build the business behind it, which we're good at. And now it's, hey, let's find a way to make real estate very sustainable long term. Let's set it up so we don't have to sell it. Let's set up with the right management fees, which was a huge win. One of the number one decisions that we made early on in syndicating our deals is that we built in management fees to sustain our company if we stop doing deals. Like we can not do anything and we can keep all of our people at our company. Not many syndicators have that going for them. And also, I had a lot of reach for LPs. I had a big base of LPs, so we got to decide, like, okay, how do we want to position this? Like, we're running a company. It is a service to our investors. How are we going to position this? What type of LP are we looking for? And yes, there's LPs that ask you right away, what's your IRR? When are we going to sell this thing? How much capital can we make? What's the MOIC? Multiple on invested capital. What's the exit? There's other LPs that are like, hey, Nick, how long can we hold this thing? How can we not pay any taxes? And how can we reduce the downside? Like, a lot of times the incentives are not really aligned with LPs and GPs. A lot of GPs are encouraged to, hey, let's do deals and let's sell deals so that we can get our promote. And that creates a ton of loss that's in our industry with transaction costs and all the people that work on transacting real estate and just how expensive that really is. And then also the horrific tax efficiency of buying a building and selling it 3 years later, if you're not going to 1031 it or whatever, which is kind of hard when you have a massive amount of LPs. And when you, the GP, want and need your promote, you can't really do a 1031. So we said, all right, if we're going to build a portfolio that we're going to hold here for 10 years, and we can buy, $10 million or $100 million a year, whatever the market gives us, take opportunity as it comes. We can sustain our people in the slow times, which is right now, it's a really tough time, which we can talk about. Or we can really get aggressive and buy a lot of storage when things get good. What do we need to do? And ours was, hey, let's find LPs who want to hold on to property for a long time. They're not interested in IRR. They're not interested in flipping a property. They're not interested in paying taxes, and they want to just hold. They want to put money away. They want to make money every month, and they want it to multiply without exits, liquidation, taxes. So low leverage reduces the IRR. If you're going to buy a deal all cash, it's really hard to see a 10 or 12 and an IRR more than a 10 or 12, especially if you're not, projecting massive rent growth and big exit cap rates, low exit cap rates. So if you're going to be realistic about your projections today, we're looking at 10 IRR. Not many LPs are going to be pretty excited about that, but we're using zero bank debt, which reduces almost all of our downside. We're not going to lose this property. In what world are we going to lose this property? And then, we can kind of set up a structure to buy and keep the flywheel going in a different way. Early on, it was, hey, let's maximize returns. Let's get in this promote. And today it's, let's figure out a way to set this up so we can hold these things for a really long time.
So it also sounds like you were very intentional about making sure what kind of investor base you want to move forward with, because you don't want to get the stressed out ones that call you all the time. You want the people that trust in the business plan. They want the quarterly reporting. They know what's going on. They want to receive the annual reportings and stuff. But overall, they're very comfortable, just sitting tight as their wealth grows.
Mm-hmm. Yeah, early on, I was selling LPs when we were doing that very first deal, and I didn't know what I was doing. I was 25 years old. My sales method was I'm gonna barge into a meeting, and I'm gonna talk about all the good things. I'm gonna talk about how we're gonna make all this money. I'm gonna talk about the exit valuation. I'm gonna talk about our operational prowess. I'm gonna talk about how just this is gonna be a rocket ship, and you need to get on board. And it was kind of an all good mentality to sell real estate investment. I was a GP. I've shifted today to a different sales model that makes my life a lot less stressful, in that I get into a meeting with a GP or an LP, a potential investor, and I'll say, all right, you wouldn't be on this call if you didn't like self-storage as an asset class. I'm going to make that assumption. So throughout the call, I'm going to talk about the downsides. I'm going to talk about, hey, what if interest rates rise to 7 or 8% over the next 2 years? These are calls that I was having in 2021. What if interest rates rise to 6 or 7, 8%? What if housing transaction volume drops off a cliff and self-storage demand goes down? What if we can't refinance and pull out any cash? We can't liquidate. We're stuck together for 10 years. And what if when it comes time to refinance, we have to put bigger debt on it? It's more expensive. And our yield goes from 8% down to 3%. And we're sitting holding that for 3 years. Like, how are you going to feel? And they would say, well, this is not okay. And they'd hang up the phone call, and I would never hear from them again. But most of them, the people that we wanted, the people that kind of we knew we were going to go to battle with in a less stressful way with lower expectations, They said, I understand that that's how real estate works. I understand that. If you're a good steward of my capital, if I feel like you're doing a good job managing these assets, I am not looking to live on this money. I don't need this cash. I don't need it back. And I'm not tied to the yield that I'm getting every month. Like, this is something that I'm perfectly fine with to ride out a storm with. And here we are today, riding out almost the exact same scenario. So 2 things happened. 1, we got great partners. And 2, my life as a GP got way less stressful, because stress, in my opinion, is like the mix, the gap between expectations and reality. That's stress. That's where stress exists. If expectations were up here and reality is down here, you're going to be stressed out, because you're not delivering what you told them you were going to deliver. So the better you can do at managing expectations, and this is with people you hire, this is with your tenants, this is with your investors, this is with everybody in your life, like literally my children. Any time you're dealing with somebody and you set really high expectations of what they expect out of you, you're setting yourself up to get really stressed out, and real estate's no different.
Yeah. It's kind of part of the human condition, and it goes back to in order to psychologically recover loss, you need twice the gains. And so it's like nearly impossible to actually satisfy people once you overpromise something. Yeah,
and today the real estate market, we've seen, to put it in perspective, we bought $50 million of storage in 2021 when rates were 3.5%. The next year, 2022, the first half we closed on a lot of deals, but on the year in general, we bought $34 million of storage, and this is with a lot more effort and emphasis and a better company when it comes to deal flow, underwriting, lead generation. And 2021 was an insane growth year for my company. We went from 6 full-time employees and like 7 storage facilities to 50 plus storage facilities and 45 employees at my company at the end of 2021. So 2022 was a breather year. We caught up, we built better systems. We, built our company. It was a great year to focus on what we were doing and what we needed to do. 2023 has been extremely slow. We've closed on 1 deal this year, $1.2 million all cash so far. And we're halfway through the year, which is tough to swallow when you have 3 acquisitions, cold callers, we have 4 underwriters, we have investor relations teams, we have property management teams, we have property improvement teams, we have customer service teams, we have customer collections teams and auctions. So yeah, it's a blessing that I got advice very early on to build a company charging the right fees, meaning, hey, it's very, very tempting as a new GP, as somebody who's just getting started and they're going out and raising a lot of money for the first time. And a lot of family offices will beat you up on fees as a job anyway. A lot of LPs, if they have the leverage, they'll beat you up on your fees anyway. But we said, hey, look, if you want a GP that's going to be low fee and, very cheap running your properties, we are not that person. We need to hire good people, period. Like, we need to be able to hire good people and keep them even if we stop doing deals. So, the 1% AUM, the 6% of revenue management fee on the property, the 3% insurance goes to us. Like, we build our property and our setup the right way to sustain our company, and we're very, very thankful we are doing that, and we did that.
So who gave you the advice to do that? Because it's such a crucial piece to the puzzle. It's such a crucial piece to being a sustainable company, particularly in this year right now.
It was Chris Powers. Do you know who he is? He's a industrial syndicator in Dallas, Fort Worth, a mentor of mine and really good friend. His company, Fort Capital, has exploded. I mean, we're talking over $1 billion of industrial real estate acquired throughout Texas and the South. So he came to me early and said, hey, Nick, you're going to get a lot of LP interest. It's like, do not make the decision that you don't want to go with one big LP. And like, there's the decision, like, go for one big investor who's going to be your primary investor. And we get pitched all the time. All syndicators will get pitched, hey, I'll be your one source of capital. You don't need to stress about capital. It'll be an amazing win. We're going to invest in all your deals. Or go out and raise $50,000 to $250,000 checks we have 320 active investors in our deals. So we made the decision to say, no, thank you. We know you could be our one partner, but with one partner comes leverage. And with that leverage comes the ability to beat you up on all your fees. And if a year later something happens with their fund and they no longer want self-storage exposure, what they told you in the beginning doesn't necessarily mean anything. They can pull out and they can stop investing in your deals in a heartbeat, and then you have no ability to keep raising money if that one partner kind of changes their mind and says they don't want to invest with you anymore.
Yeah, you have a single point of failure versus, building an entire network of sustainable relationships that you can work with.
Yep, exactly. And so we've elected to go that route.
Yeah, I think I've seen more syndicators getting hurt with that kind of single LP mindset than the other way around. Also because of the leverage that you mentioned, they might stack the deck slightly different. They might ask for different fee structures, and it's not in your favor. I think it's better to maybe take the work on and go the slightly longer route and build those sustainable relationships with maybe initially smaller relationships, smaller size checks, but build those in a sustainable way. And if these people are smart enough to figure out how to get you $250,000 in the early stage of their career and be part of the trust that you're building over 1, 2, 3 decades with these people will balloon into a completely different level of operation and check size in the future.
Yep. Yeah, it's and these people are going to battle with us now. I mean, look, it's tough out there. It's tough. We have maturities coming up. It's June 13th, this recording of 2023. We have some maturities middle of 2024, so coming up on 1 year away, and we're going to need to sustain some, cut our distributions in half to start stacking a little bit of cash for these tricky refis, and it'll be interesting to see how the whole real estate market shakes out over the next couple of years.
Yeah. So what's your personal assumption, given that you're the steward of over 300 LPs capital? What's your personal assumption? How do you set yourself up? Besides the fact that you're not taking on any leverage, but where do you see things playing out from a personal sentiment? What are you seeing?
Yep. I'm confident in our portfolio right now. I think that things could get a little bit worse, and we're not going to have capital calls out of refinances, which I think is a lot more than most syndicators can say if they have maturities coming up the next year. But look, I don't get paid to be a bull, and I think I am bullish. Like, I think that interest rates are not going to go up from here. I think they'll stay here for 18 to 24 months, and it'll be a lot of pain hit the market. But then I think they'll recover, they'll drop, and as we enter the next cycle, it'll go back to a new normal with interest rates near 5% for a while. But I'm not in the business of predicting what interest rates do. I'm in the business of predicting or protecting my capital and my LP's capital. So I am preparing for the downside. I am making sure that if this crunch gets worse, if regional banks lending gets worse, if a debt crunch happens and that will crush real estate values, if that happens, we're not going to lose any properties. That's my job. And I'm confident in it right now, but yeah, I'm not smart enough to know what might happen here.
I think it's not about. I think the majority of people don't know what's going to happen. Actually, one of the few voices that I pay attention to, maybe when it comes to future projections, is Ray Dalio. Like I've just tuned into one of his very recent.
He's very bearish. Ray thinks that the economy's melting.
He thinks he's melting, but he also thinks that's a reason that interest rates have to go down. So he thinks that we're at kind of the upper level of where interest rates will be over the next couple of years, and he thinks that they have to come down because otherwise they will break too much.
Mm-hmm. Yep. I mean, I know that it'll break things. I know a lot of GPs that are stressed out right now, thinking about maturities in the next 6 to 12 months. And it takes forever for those things to bubble up. I mean, there's a lot of stress going on in the background of the real estate world. Talk to the debt brokers. They know the debt brokers always have a bead because they have a bead on all the banks. Yeah. They know where the syndicators are in their cycles. And debt brokers have an extremely stressful job right now. Extremely stressful. They've never been more important and they've never been more stressed out. And that's a sign that as more and more of these deals just don't get done, as they have too much leverage, they just don't get new debt put on, the foreclosures start. It could get really ugly. If interest rates stay up here where they are for 24 months, we're going to see a real estate collapse. So I don't know how they could stay this high for that long.
Yeah, and that's, now we're talking in a niche that you and me are in, and Ray Dalio is looking at it from a even more macro level. He's like, this is just a niche imploding. And, if that niche implode, we will see regional banks implode. And if regional banks implode, we will see this whole ripple effect that will go up and really impact the macro level of the United States.
The fact that 10% of Americans haven't had to pay on their student loans for the last 3 years is mind-blowing. And that starts back up in September at a serious clip. So a lot of consumer spending is going to go off the table when that starts. So who knows what will happen there.
This whole student loan forgiveness is so dumb. Like, it's okay if you put a brake on it because of COVID, but like the idea that like all of those 6-figure income earners or whatever, that nonsense, like don't even get me started on that.
Yeah, I agree. It's not my place to weigh in on that, but I'm with you.
Yeah, I mean, see, I'm an immigrant, and I came here with nothing. I made minimum wage when I first came here, and I see the people lining up in this country legally. Not everybody that just crosses the country right now, but they're working their fucking ass off to make ends meet, and then I see that they're forgiving on those student loans, and I'm like, how can you do that to your working class? You're just showing them the finger.
Mm-hmm. Mm-hmm. Yeah, it's a tough issue, but yeah, I don't think that forgiveness should happen either. I'm with you. Yeah.
Anyway, let's shift gears a little bit. You mentioned that you have a fairly sizable team at this stage, over 40 full-time people, but you're also very strong on having them overseas. How do you build a team effectively that actually exhibits your culture? And I guess one of the things we've seen is work from home is good if you have an existing team culture, but I wonder what it looked like for you to hire overseas and drive performance, engagement, culture, and I know you have people in South America as well, in Southeast Asia. Mm-hmm. So how did you do that?
I think before we talk about, I do want to talk about Latin America and the Philippines because it's a huge part of who we hire and how we hire them. But before we talk about that, I want to say a couple of things about culture. We read about culture on social media and in the business books, and you think that culture is, sick time and paid leave and ping pong tables and parties and summer early Fridays and going to the beach and unlimited vacation policies and work from home and all these perks. And yes, that's part of it. But you want to know what really creates an amazing culture inside of a company? It's A players working with other A players. Okay. In my opinion, like all employees are either an A player, a B player, or C player. C players are the people that are doing are a drain on the company. They come in, they're not actually adding more value to the company than what they're getting paid. The B players, they have a role, they're doing their jobs, and they're easily replaceable. The A players are the ones that are making the decisions, that are working hard and really adding value to the company. They're making X and they're adding value, a multiple above that. We need A players. You need them. I need them. All companies need A players. If you want to keep them around, that's a different story. Like recruiting them is one thing. We can talk a little bit about recruiting, but keeping them around is culture. And to keep around an A player, there's actually two things that really upset and make an A player want to go somewhere else. The first one is working with people who are not good, working with incompetent people. So if you as a boss, if you tolerate incompetence in your company, you're going to get more of it. As a boss, you get more of what you tolerate. So if you tolerate incompetence, if you tolerate poor decision-making, if you tolerate a low work ethic, you're going to get more of it, and your A players are going to be incredibly frustrated. You've been there, I've been there. You're on a team, people are not pulling their weight. It makes your job harder, it makes your job more stressful, and it makes you feel inequity in the workplace, okay? The second thing is decision-making. As a boss, if you make decisions slowly, your A players will want to leave your company. We've been there too. Like we go to our boss and we say, hey, my job could be made a heck of a lot easier if we did X, Y, and Z. All we got to do is X, Y, and Z to make my life better. Nothing happens for a week. You go back to your boss and you say, hey, look, I'm still stressed out. The communication method, the software we're using, I got 3 or 4 little things that we could do very quickly to make my life easier and make me more productive. You leave the office. Well, first you get promised the world. Oh yeah, we're moving on that. We're going to do all these things. You go back to your desk, keep working. A week later, nothing happens. A month passes, 6 months passes. You realize that your company is going to make 0 changes to improve. They don't want to change. They want your butt in a seat to do X, Y, and Z. You as an A player are going to be out of there. Okay, so to build a great culture, I do 2 things. I fire people who suck very quickly, and my A players appreciate that. And I make decisions really quickly. One of my employees comes to me and says, hey, Nick, I'm really bogged down with some admin tasks. I don't like it. Can I hire an employee, an assistant that works for me? And if this is one of my A players, yes, I'll have resumes in your inbox, and I'll have HR on the horn tomorrow. Okay, I'm going to post a job right now. Okay, that's the difference between a place that somebody wants to work and a place that somebody doesn't want to work. Okay, so culture, yes, there's a lot of things about culture, but we make decisions quickly and we get rid of poor performers. And that if you do that over time, the compounding effect is incredible.
I mean, I totally get that, and it's it strikes a chord with me in so many ways.
Yeah,
because I think that this. Yeah, go ahead.
Yeah, and if we want to talk about recruiting and getting top talent, the truth is that most super competent A players, they have a job they like and they have a boss that doesn't want to leave them. Like that's just the bottom line. And look, you don't need to staff a company full of A players. They go out and say, you read a lot of business advice that says like, it's all about who you hire. If you hire good people, you're going to win. Go out and find great people. And you see interviews of business titans and they'll say, oh, I was just blessed to have amazing people around me. That's the key to my success. That's the key to my success. And there's nothing less actionable. And there's no worse advice if you're a person starting out and you need an employee to go sit on a lawnmower and drive it around a yard. Okay. I'm not going to be able to find great people to do that. So very early on, me and my business partner, we were complaining about the people. Oh my God, these people suck. Why can't these people do their job? And we learned really quickly that, hey, it's us. It's our business. It's our systems. The average employee doesn't want to is never going to care about your business like you care about your business. The average employee wants to work 40 hours and they want to go home and watch Netflix and they want to get paid next Friday. That's what the average employee wants. So you better build a company full of those. So B players to do all the things that need to be done. And then when it comes to decision making, when it comes to management, when it comes to those key roles, that's when you're after those A players. And the truth about the A players is that they all have jobs. If the A players have jobs, they have a job they like or that they're okay with, and they have a boss that sure as heck doesn't want to lose them. They have two things, okay? They have a boss that's willing to do a lot not to lose them, and they have a job they like. I look at the workforce as, okay, 20% of people are unemployed looking for a job. Okay? 60% of people are in a job that they think is okay, and but they're open to other opportunities. They're open to something better. The top 20% is in career nirvana. Their jobs are perfect. They're actively, they will turn away any opportunities because they're in a really good spot. You got to find people in that middle 60% that are good at what they do. They're not actively looking for a job, but they are open to other things because there's a couple things they don't like about their current opportunity. Maybe they're working with incompetent people. Maybe their bosses make too slow of decisions, and you're going to go in and try to find those. So some of the key people that I've found over the years in my management roles, when I'm building my decision-making team, I went out and sold them. I put my sales hat on and I went out and sold them on coming to work for me. Now, if we want to talk about Colombia, Latin America, the Philippines, an interesting thing about my real estate.
Absolutely. I love it because I also went down that rabbit hole and I tried to hire from different countries. And there's a couple of countries that I can absolutely not work with because of some of the cultural values that they have. So I'd love to hear your take on, Latin America, Philippines, and why you love to work with some of those.
Yeah, so my entire world changed. My management world changed in 2021 in April when I went to a company called Support Shepherd. You can visit it at supportshepherd.com if you're listening or watching. I went through them. My friend Marshall owned the company, and he set me up they basically recruit people over there for you. They help you build the job description. They bring in candidates. You interview them, and you hire them, and then they're your employees. I set up a contract with Shepherd. They brought me 3 employees. Over an hour period, I had 3 20-minute interviews right back to back with 3 different candidates. I was so blown away, and these were all in the Philippines at the time. I was so blown away that I hired all 3 of the people. I was like, I could not believe it. I was like, these people are eager to work. They have great English, and they have a great experience. They're good communicators, and I can pay them $10,000 a year, $10,000 to $12,000 a year, $800 to $1,000 a month, $4.50 an hour to come on my team and start kicking serious ass. It blew my mind. My head blew up. I was like, I'm sitting here trying to hire Americans for $60,000, $70,000 a year, and all they want to do is negotiate for more money, more vacation time, early Fridays, and they got problems all the time or reasons why they can't come to work. Okay, so I hired all 3. One of them now, 2 years later, is the head of my customer service team. 15 people, 24/7 customer service. He's making the schedules. He's hiring. He's firing. He's managing the entire customer service team from the Philippines. Obviously, he's gotten a raise. Another big hire was a little bit later that year through Shepherd. We hired somebody in Colombia, same time zone. And today, if you fast forward, we have 45 employees. 10 of them are Americans. 15 of them are in Colombia, and the rest are in another 15 are in, or 20 are in the Philippines. So
Philippines, yep.
Yeah, my company has 45 employees, 10 Americans, and my overhead is $1.3 million a year. That's what I spend on my real estate team. If I had to do the same amount of work, and we're 24/7 customer service, we're managing, over 150 subcontracts and vendors at all of our properties to clean all of our properties. We have 1.9 million square feet that we manage. We're auctioning off over 1,000 units a month, or not a month, but a year. We're doing over 1,000 unit auctions a year. These are, this is a team that would cost me $3 to $4 million in the States and more if I had an office. So the savings is unbelievable. Now, the difference between the Philippines and Colombia is an interesting one. I think when it comes to verbal communication and repeatable tasks and organizational skills, the Philippines is amazing. Like, their English is really good. Repeatable tasks, they're great. Data entry, customer service, even some sales stuff. They're selling new customers. And then when it comes to management and kind of autonomy, we're hiring in Colombia, and we're getting engineers, good decision makers, people who are negotiating with contractors, and the written English is great. Spoken English is not quite on par with Philippines, but still great as well. And we're having a ton of success. We have, out of my 45 employees, I'd say there's like 6 people who are like 10Xers. Like they're very good. I can see, promoting them to run the company someday, or even run some of my other companies that I'm doing. Of those, 4 of them are in Latin America and the Philippines, which you would never expect. And they were all hired for less than $1,200 a month.
Yeah. And it's crazy. The work ethic that I've seen with also, I've hired in the Philippines. I did go through an agency like Shepherd. I actually went through the headache of vetting them all myself and set up the interview process myself, which in itself shows you, it teaches you something, but it also takes away your time and resources. But at the same time, I was blown away by the work ethic I found over there. And it's just like you said, not only it's a fraction of the cost to run your team right now, but you have a completely different level of engagement and work ethic. Like if you would have the same kind of team with some of the repetitive tasks, and you would have an American sit there, it just wouldn't go as frictionless as it's probably operating for you right now.
Yeah, I think there's 2 levels of delegation in a business, and the first is just tasks. You need somebody to do repeatable tasks. That's maybe half or 2/3 of operations in a business. Do the same thing over and over again. And then there's like the decision-making level of delegation, which is harder. And some business, until you get to 5 or 6 employees, all decisions can flow through you as an owner. But as you start to grow and scale your business past 15, 20 people, you can't make every decision in your business. And I've been very surprised that some of the Filipino and Latin American employees have taken to the decision-making side of things very, very well. And just been incredible assets for our company.
What kind of characters are those that are actually taking to the decision making? How do you identify those? Do they self-select themselves? Is there something you can point to where you're like, this will be a decision maker?
Yeah, so decision making is a muscle. People think it's a skill that can be learned, or like an art that can be studied. Decision making comes from practice. Like if you're trying to build a muscle, if you want a bigger bicep in the gym, you're going to go to the gym and you're going to lift the weight, right? Decision making is no different. So if you don't have any practice making decisions, you're going to make poor decisions. It's all a feedback loop. You make a decision, you see what happens, and you adjust your next decision. So as a business manager, it's your job to kind of create and see who can become good decision makers by letting them practice with low stake decisions early on. So they come to me, they'll say, hey, Nick, I got a problem. This, that, or the other happened with this customer. I don't know what to do. And I'll respond to them and say, and look, this is the why in the road as a business owner, where you have 2 options. You can say, get out of my way, I'm going to do this. That's what most business owners do. Or you enable that employee to figure it out and make their own decision. It's easier in the moment to go and just say, get out of my way, I'm going to solve this problem. That's what most people do who are running a business. My strategy is, okay, I'm going to get a look into this person's brain and make them think about this. So I'll respond with questions right away. Oh, I know that seems like a pretty big problem. What would you do about it? What's your potential solution? What are our goals here? What are the factors? What's most important? I'll ask those 5 questions in the span of a 5-minute conversation, and 2 things happen. Number 1, the employee starts to think for themselves. They understand that they can't just go to Nick and dump the problems on Nick. They're not going to be able to do that. And number 2, I get to look into their mind. I get to look into their mind, and while they're talking to me, I get to see how they are at decision making. And then I can enable them to make more decisions. If somebody comes to me 3 or 4 times and says, hey, Nick, I got the same problem. They're having the same conversation with me. It's pretty clear to me that they're in the incorrect role. They should not be in a role that requires decision making. And a lot of people can't do this. Decision making is incredibly hard. 60% of people in America make horrible decisions. That's why they have $500 or less in their checking account, period. Okay? So you need to find the people who are good at making decisions by letting them start to talk through it. So some employees will come to me and they'll say, hey, Nick, I got a problem with X, Y, and Z customer. What do you do? And I'll do this exercise and I'll have them think through it. And their responses are kind of meh. I don't really understand that they get it. Next week, the same question comes to me again. And they're coming back to me asking the same thing. The next week, the same thing. The next week, the same thing. It's clear that that person is in over their head and they need to get out of that role of decision making. But every now and then, an employee will come to me and they'll say, hey, Nick, I got a problem with X, Y, and Z customer. What would you do? My response is the same. It's, hey, what are our goals? How do you think about this? What would you do? And what are the factors? And they start to talk to me. And then I'm just like, wow, they kind of understand it. I send them on their way. They solve their own problem. And then they come back to me the next day and they say, hey, Nick, I just wanted to let you know X, Y, and Z happened. And this is what I did. I went through the same thing. What we talked about yesterday. That's how I solved it. Does that sound good? Yeah, good job. Or sometimes they'll do that and it'll be all wrong. And I'll be like, whoa, you were not supposed to do that. That's a horrible decision. Demotion, the trust level drops. But if they're good and they're answering these questions the right way, the trust level goes up. And as the trust level goes up, me as a business owner, I can have more faith in that customer or that employee. I can enable them to make more decisions, and I can just make those decisions a little bit higher stakes. And I'm the entire time I'm getting a look into their mind. They're getting practice making decisions, and then I can enable them to kind of grow and do more and more inside of my company.
How do you think about reward and recognition with your team? Is that something that you're actively or making part of the culture, or maybe rather your habits, or how do you handle communication on that level?
Yeah, all praise, a lot of praise is in public, and all critiques are in private. I never critique my team in front of other people. But yeah, it's a balance. I'm not, people who are direct reports to me, we can be friends, but it's not going to be a goody friendly, I don't know how to say this without it coming off wrong, but it's not going to be Nick's going to be your best friend at work. Okay. This is a business relationship. I expect X, Y, and Z out of you. You can expect X, Y, and Z out of me. We're here to do what's best for this company. Away from work, we can drink beers, play golf, whatever. But it's pretty clear that, when somebody's doing well, I'm going to reward them. I'm going to give them public praise, and I'm not afraid to do that at all. So definitely. But I think, there's a lot of people, I kind of feel strongly about this. There's a lot of people who put their employees in a profit sharing plan and on a chunk of the promote, and kind of think about incentivizing them with profit. And I know people who do it really well at higher levels, like when their companies are bigger and you're hiring big executives and management people. Yeah. If your company's small, if you have less than 20 employees, I think tying somebody's compensation to profit or revenue is not ideal. Like, look, employees don't necessarily want chaos. They don't want, an unstructured environment. They don't want to not know how much money they're going to make next Friday. They're employees for a reason. They want to have, very clear understanding of how they're going to get paid, what they need to do, and they want you to give them the tools to do that. So as far as compensation, yes, we'll do spot bonuses. Yes, we'll do performance-based bonuses, but we very, very rarely tie compensation to profit or revenue.
It's interesting that you said it. It's something that I personally tried with one of the key players that works with me. And I thought it was like a great way of giving back, and it just didn't hit it at all. It was like, almost like went over the head. And I'm like, this was such a great opportunity financially for them. And I was like, it just didn't land. Just like you said, they just want to know this is what they get. It was something more tangible, and I guess this is the difference between ownership and not ownership. Employees
don't want to be cut in on profit and revenue. If they did, they would be entrepreneurs. So almost every time I try this, it becomes overly complicated. It becomes a paperwork nightmare, and it's not actually accomplishing what I want them to accomplish. My job as the business owner is to worry about the profit and the revenue. Their job as the employee is to do their job. Let me worry about the profit and the revenue. I'm going to pay you X amount of dollars every 2 weeks. That's been a great, it's been a great system. It's been around since the beginning of time. Turns out it's a great system.
Yep, and it works. Well, Nick, thank you so much for all your insights. Now you have time. A couple shameless plugs for all the different companies you're invested in, everything you're working on. Where can people connect with you? Where can they hear all of your rumbling storms on Twitter?
Yeah, so you can follow me on Twitter at Sweaty Startup. I write a newsletter every week that I put a lot of thought into about real estate and hiring and management and building teams. You can find that at sweatystartup.com. You can subscribe to that newsletter. And yeah, there's some links below of the different companies that I'm invested in and partnered in. But look, I'm a real fan of what you do. Thanks for having me on, and this has been a great talk. I really appreciate it.
Yeah, likewise. Thank you so much for taking the time, and I'm always interested in the different events you keep popping up. So everybody is listening. Nick is very out there on social media. We will put everything in the show notes, so you make sure to follow him and see what he's up to, because I'm sure there should be a second conversation once you're hitting like $1 billion in assets under management, because you're going to grow like crazy. You're just getting started. I can see it.
I hope so. We'll see what time does, and I hope that I can continue to make some decent decisions to keep this thing moving forward.